Hello everyone. How are you all? I'm sure you're doing great. Now, we have done earlier 100 MCQs for section A, and that was a section A marathon where we covered 100 MCQs. Now I have come up with section B marathon where we will be covering today 5 case studies. Okay, so all of us, let's get up, and I hope everybody is ready with the pen, paper, and calculator so that we can start right away the case studies. And I will tell you the methodology with which you should be solving your section B questions, as well as we will be solving them quickly so that we know how to answer our questions within the time frame. So I hope everybody is ready to go. Please just tell me once before we proceed. Is the audio video clear? Absolutely, there are no laggings, nothing, and absolutely everything is comfortable. Just tell me that in the chat box, please. Yeah, kindly type it in the chat box. Am I clear? Am I visible? And is my voice clear? Everything is okay? So that we can start with the session, and let's do 5 case studies today. Okay, fine. Now let's start with it. So let's have our first case study. The first case study I'm taking is basically based on life cycle costing. And life cycle costing, target costing are very popular for section A and B. So let's have the first question from there. Okay, this case study is of Midhurst Company, which is manufacturing. So let's start reading it. Now, first, before you start with any case study, in the exam, please understand that there's a technique to handle section B questions. So how you should be reading the questions is very essential. Let's start reading it. Midhurst Company manufactures air conditioning units and is considering an investment in a new unit that will be used in modern office buildings. Advances in technology mean that this unit is more sensitive to changes and variations in temperature, and therefore it can regulate airflow and heating more effectively. Midhurst Company competitors currently do not have an equivalent product and they can or that can offer these features. So they currently do not have this product. Now, I would not read the in-between data. I will directly see the requirement, and accordingly, I will be reading the portions. Now, the first one, according to the life cycle costing method, which two of the following statements regarding the stages of the life cycle are true? Okay, which two are true for the as per the following following statements about the stages of life cycle? Let's read it. At the introduction stage, further capital expenditure will be needed as production capacity will need to increase to meet the demand. So this we need at the introduction phase. Okay. Yes, we need more capital expenditure at introduction phase. We've already covered it. The maturity stage occurs when the market has reached saturation point and bought enough of the material, enough of the product. This also looks correct to me. Okay, the majority of a product's life cycle costs are determined by the decisions which are made at the design and development stage. Actually, this looks more correct. So let me just come to this point then, because majority of the product's life cycle costs are determined by decisions which are made at design and development. Absolutely. The growth stage, when sales will have reached their peak and become stable, will be the most profitable stage. The growth stage is not the most profitable stage. Maturity phase is the most profitable stage because that is the stage where sales are at peak. So this is the wrong answer. The maturity stage occurs when the market has reached saturation point and bought enough of the product. No, no, no. When the sales are at peak. So maturity stage is the stage where the sales are at peak, because this is the line that we use for decline phase, right? So I think that yeah, that is the statement wrong. So this is wrong. The correct answers are 1 and 3. Let's go to the next one. What is the cost per unit for the new air conditioning unit using life cycle costing? Okay, so life cycle costing, we need the cost per unit for the new air conditioning. Okay, so for that, let's see the data, and what you have to do, you have to calculate the cost from top to bottom. Now let's read the entire portions, so then we can calculate the cost accordingly. Midhurst company expects to sell 10,000 units over the predicted 5-year period of the life cycle of the unit. The finance director has prepared the initial costings for the unit. Okay, so the initial costings have been prepared. The finance director plans to use life cycle costing to measure the profitability of the new product. The chief executive has asked for more information about the life cycle costing, as they are not sure whether it is the right method to use or not. The production director has reviewed the costings in detail and suggested a couple of changes. They are enthusiastic about the product and believes that modifications could be made to prolong the product's life, but wonders when is the next the correct time to make the changes. Okay, we'll come to it, but let's calculate the cost. So the number of units are 10,000, which is given to you here. Now all those who are with me and watching the video here, watching the live session here, the next question, guys, you have to do it. So in case if you don't have pen, paper and calculator, quickly grab it. Okay, yes. Now let's calculate the total cost. So here it will be 6,200. Simply I will just write it here only. So yes, I will take 6,200. I will take design cost, because we take cost from start to end. We will take marketing cost and variable production cost also, which will be 42 into 10,000 units, 42,000. Then I will take fixed production cost, again variable distribution cost. So 9 into 10,000, which is 90,000. It is not 40,000, 420,000. 10,300. Then again variable selling cost, 4 into 10,000, which is 40,000. Then fixed selling cost and administration cost. Now add everything and you will get your total cost. So my total cost will be, let's take the calculator, 6,200 plus 33,450 plus 177,685 plus 420,000 plus 90,000 plus 98,470 plus 10,300 plus 40,000 plus 7,790 plus 23,450. I get here 90,7,345. So my total life cycle cost is 90,7,345. Okay, my total life cycle cost is 90,7,345. No issues, no issues, no issues. Okay, Revati, that's completely okay. What you will do is, after this question, I'll give you time to go through the text. Okay, I'll give you time to go through the same. Okay. I'll give you time to catch up. Okay, now this is the total life cycle cost, and I will divide it by the number of units, 10,000. So I will get my cost as 90,734.5, right? Which is my life cycle cost per unit. So 90735 is the correct answer, because it is the cost per unit rounded off. Okay. Now the next one. The production director has suggested the following changes for the costing of the new unit. Okay, for the costing of the new unit, just 1 minute. Currently, the material costs are 20% off the variable production cost per unit. Okay, so currently the material cost is 20% of the variable cost per unit. Just a minute. Just give me a minute. Sorry. I hope Devti now you would be able to answer it. So all those who are watching the videos, in case if you want this section B file, just connect. Please drop it in the comment section, and I will share the file so that you can do the questions more quickly and be with me. Okay. Like with Revati, I just shared. Now, currently the material cost are 20% of the variable production cost per unit. What is the variable production cost? For 420,000. That is 42, right? 42 per unit, if I say. So the material cost, current material cost is 20% of 42. Correct? One of the materials used is stainless steel, that is budgeted at 2,000 per unit. The figures are in thousands, so 42,000, right? So it will be 20% of 42,000 will be 42,000 multiplied by 20%, 8,400. Now the question tells you that one of the material used is stainless steel, which is budgeted at 2,000 per unit, but an alternative corrosion resistant material costing 25% less can be used. So we can use an alternative material also, which is 25% less, which cost 25% less. The production director believes a 50% discount can be negotiated for the remainder of the material. That means 2,000 will be treated differently, and remaining 2,000, other than 2,000, the remaining cost of the material will be taken at 15% discount. Correct? So what is the revised material price? The revised material price will be, first I will take for the 2,000 value. So if you see, this is the 2,000 cost, but then it says that if we use an alternative material, then this will cost 25% less. That means this will only cost 75%, right? And other than 2,000, the total cost is 8,400 per unit. You reduce 2,000, then the remaining cost will enjoy 15% discount. That means it will be at 85% cost. Now you add the two and you get your revised material cost per unit. So I am sure everybody is following. Revati, please just confirm, have you received the file? So this is 1,500 and 8,400 less 2,000 multiplied by 85% is 5,440 plus 1,500. My revised material cost comes out to be 6,940. Okay, anyone who's not able to follow anything, please ask me in the chat box, and I'm sure when I'll explain you that, it will be absolutely clear. So anything which is not clear, quickly put it in the chat box. Yes. So here my answer is 6,940. Clear? Let's go to the next one. The production director has also asked about the implications for production planning if the company wishes to extend the product's life cycle. So at what stage of the product life cycle is the new unit most likely to undergo product development? Product development, the new unit. Okay, now if you see, when you want to extend the life cycle, you basically want to extend the sales, or the sales of the product, the overall profitability of the product. So in which stage do we extend the sales of the product? In which stage do we have the maximum profits and the maximum sales? Maturity. So for example, the Swift car of Maruti Suzuki, it remained as a top car for around 8 years, but then still it wanted to be there in the market, so it started bringing lot of versions of the Swift car, so that the car remains in the market and the customers are still interested in it. But at which stage they were doing it? Were they at the introduction phase? No. Were they at the growth phase? No. Were they at the decline phase? No. So they were at the maturity phase because that time Swift was ruling the market. Clear? So at maturity phase only, in order to extend that phase, the new versions were introduced. So always remember, the new versions will always be introduced at the maturity phase. Okay, so here our answer will be maturity. Now, the chief executive wants to be briefed on the advantages of life cycle costing. Which of the following statements relating to the advantages of life cycle costing are correct? It draws management's attention to all cost relating to a product which other costing methods usually treat as period cost. Absolutely correct. Other costing method will treat fixed cost as a period cost, but then we take it as a cost here, right? So we consider every cost, whether fixed or variable or semi variable or an introduction cost or a decline cost. Every cost will come here. Next, it draws management's attention to all costs relating to a product which other costing methods usually treat as period cost. How it is the same? Okay, I think some printing error. Okay, next. It focuses on what consumers are prepared to pay for a product. What consumers are prepared to pay for a product, and establishes cost budgets based on expected selling price. Don't you think it is talking about target costing? Because if the cost budgets are based on expected selling price, that's target costing, so definitely not a point of life cycle costing. Next, it aids understanding of the relationship between decisions at the design stage and the cost of other functions like marketing. Yes, everything is included here. So yes, the correct answer is 1, 2 and 4, option B. I hope I'm very, very, very clear till this point. Revati and others, those who are following, I think it's time that you try the second one. So I give you 5 minutes. Please go through this case study which is there on the screen. The complete case study is there on the screen, and then we will solve questions. Okay, I give you 5 minutes to go through the same, not 5 minutes, let's have 2-3 minutes, then I will read it. So quickly have a look at the case study for 2-3 minutes. I will also read the case study and let's try to do these questions. Okay, and please read it the way that I've told you to read section B questions. But currently I wanted to read it in full because we'll be doing the questions right now. So please read the section B questions in full. Okay. Okay. Quick guys, a minute more and then I will read it. Quickly read this second case study in a minute. Okay, I'm sure you all have read it. Now let's read it again with me. Home Electrics Company manufactures electrical appliances for domestic use. It is made up of two divisions, small appliances division and large appliances division. Two of the products manufactured by small appliances division are blender and toaster, B and T. And the standard cost card is given to you, which I am not going to read right now. I'll read with the solving of the question. And now let's read for the large division, but definitely these equations tell me it's about the limiting factor. Right, the large division also manufactures two products, a freezer which is product F, which earns a contribution of 150 per unit, and a dishwasher which is product D, which earns a contribution of 200 per unit. Both products use the same resources, several of which are in short supply. So these details are given to you. Now we have to answer the questions one by one. So let's quickly read and solve it. What is the contribution per unit? Per unit of the limiting factor for product T in the first quarter of the year. Okay, what is the contribution per unit of limiting factor of product T in the first quarter of the year? So we just have to do it for product T. Let's quickly do it. So let's get contribution per unit for product T. Okay, what is the contribution per unit for product T? Selling price less direct material less direct labor less variable overheads. This total is 15 plus 35 plus 18, 68. So when you reduce 120 minus 68, you will get your contribution. So that will be equal to 52. Okay, your contribution per unit is 52. Clear? Now you will, the question asks you get the contribution per unit of limiting factor. Now which is a limiting factor here? Let's look here. In the first quarter, so let me read this data further. In the first quarter of the year, the supply of material was restricted to 2000 kg. So there was a global shortage. That means material is the limiting factor here. So let's take the kgs. Now what is the quantity? What is the kgs required to make 1 unit of tea? This is $5 per kg. So I can say it is 3 kgs, right? Now I will divide it by 3. So I will get contribution per kg. Contribution per kg will be 52 by 3, that is 17.33. So my answer will be 17.33. Easy? Clear? All of you please revert in the chat box. Revati, I think you are able to follow and the others as well. Now, let's have the next question. Question number 2. Using simultaneous equations, what is the total contribution to be earned from B and T in April? Simultaneous solving of equations will help us to get value of B and T. You have contribution per unit multiplied and get the total contribution. Okay. So let's get the contribution of B and T. Here also let me get the total. So 10 plus 33 is 43. Right. So here I can write contribution for B and T per unit. Here it will be 80 minus 43, that is 37. 120 minus 68 is 52. Remember here you will need this. Okay. Now I need to calculate. So what we need is now get the simultaneous solving of the equations. So now let's read this data further. We know that this is restricted to 2000. It is now April and it has been identified that material will continue to be limited to 2000 kgs per month, but no, labor as will also be restricted to 3200 per month. Okay, this is the restriction that we have. Now please let's solve it. Very simple. We have done it in the previous session also when we discussed the section A questions. 2b plus 3t is equal to 2000. 3b plus 5t is equal to 3200. Clear? Now let's solve it. So let me multiply the numerator with 3 and denominator with 2. Right? So let's do it. So we will have 3 into 2. 6b plus 9t is equal to 6000. And then 6b plus 2 into 5, 10t is equal to 6400. Okay, now we will reduce it. And then this will get cancelled and I will get t is equal to 400. Right, because 10 minus 1 is 9. So t is equal to 400, we have got it. Now when you know t is equal to 400, put it in the equation and get the value of b. Right, so now t is equal to 400 and b will be equal to, when you put it in any of the equation, let's see in the first equation, t is 400, so this will become 1200. 2000 minus 1200 is 800. 800 divided by 2 is 400. So B is also 400. Both are 400. Now you know the contribution per unit 68 and 43. So total contribution will be Okay, let's calculate here. Right, total contribution will be 400 multiplied by 37. Okay, 400 multiplied by 37 plus 400 multiplied by 52. So total contribution will be 37 into 400, which is 14,800, plus 52 into 400, which is 20,800. Total when you add, you get here 35,600. I hope you all are able to follow and my answer is B. Clear? Okay, let's go further and let's see question number 3. Which of the following statements about the use of linear programming to resolve limiting factor problems are true? Okay, which of the following are true? Let's see here. The linear programming method, it helps to identify the optimum selling price for a product. Does it help to identify the optimum selling price for a product? No, we look at the optimum quantity. So therefore this is wrong. Slack occurs when more than the maximum available of limited resource is required. No, slack occurs when the maximum resources are not fully utilized. Only then slack will occur. So there it is wrong. So neither one or two are correct because both are wrong. Okay, next, what would be the shadow price of material in the large division? So we have to calculate the shadow price of material in the large appliances division nearest to the whole dollar. So okay, let's see what is the um, shadow price of material we need. Shadow price is the price that we that is the amount of extra contribution that will be earned for getting one extra unit of a binding constraint. So we have to see first whether material is a binding constraint or not. Okay, let's see the pointers here. Now can you see that I never read that paragraph earlier because I would have forgotten everything and then I would have read it again here. So this would be clear wastage of my time. Hence, to maximize the utilization of my time, I'm reading it along with the question now. Now, in April, only 4,000 labor hours and 2,500 of material and 3,200 machine hours will be available. The management accountant has applied linear programming and defined the constraint as follows. Labor and machine hours have been identified as binding constraints. Stop. So if these labor and machine are binding constraints, that means the intersection of these lines have given the maximum contribution. Material is not a binding constraint. So material will never have a shadow price. Material will always have a slack. Because material kgs are not fully utilized, right? Because it is not the optimum solution. So therefore, the shadow price here would be 0. Okay, shadow price is 0 for this material. Why? Because it is not a binding constraint. Please remember, shadow price is only calculated for a binding constraint. For a non-binding constraint, we still have not reached the full capacity. Okay, the fully available hours or kgs. Hence, it is not a binding constraint, and so it will always have a slack, some spare kgs or some spare hours. It will never have a shadow price. I hope I'm very clear. Now let's go further. Let's see the fourth one. What would be the, let's see the fifth one. Okay, done with the fourth. Let's see the fifth one. Which of the following statements about the linear programming method in the large appliances division are true? Now, only with respect to large appliances division. Only with respect to this. Product D has a slack value. Let's see. Product D is not a binding constraint, therefore it has got a slack value. Absolutely correct. Okay, to contribution of 76,000 will be earned from the optimum production plan. Let's calculate it, whether it's giving me a contribution of 76,000 or not. So optimum production plan is F and D. It has got 240 units and it has got 200 units. Now please multiply it with the contribution per unit. So for F, the contribution is 150 per unit, and for dishwasher it is 150 per 200 per unit. Now when you multiply it, you will get here 240 multiplied by 150, which is 36,000, and 200 multiplied by 200, which is 40,000. So total contribution is 76,000. Now let's see whether it is the correct answer. It is the answer giving in the statement or not. So 76,000 is the correct answer. Great. Let's see the next one. Labor and machine time intersect at the optimum point if shown in the graph. Absolutely correct. Even I don't need to see the graph because these two are binding constraints. Since these two are binding constraints, hence of course they would be always intersecting only at the optimum point. Clear? So all three statements are correct. My answer is A. So I hope I'm very clear. We have done two case studies so far, one on the life cycle costing and another on limiting factor. Let's see case study number 3. Okay, today we'll be covering 5 case studies. So let's do case study number 3, and this case study is made on variances, one of the most hot topics across section A, B and C. Okay, let's do this. So again, guys, I give you 2 minutes because I want it to be completely read by you so that it helps you to solve the answers and you can read it, like the way that we read. So please do the reading. I give you a minute. Okay, I'm sure you all have read it. Now I think we can start reading it and then solve it. Marcus manages production and sales of product MN at Grey Shot Company. Marcus has been asked to attend a meeting with Grey Shot Company's finance director to explain the results of product MN in the last quarter. So budgeted and the actual results are given to you. There was no opening and closing inventory in the last quarter. Grey Shot Company operates a marginal costing system. Okay, so in variances, you will be using standard contribution per unit and not standard profit per unit. Let's get the contribution here. Okay, what is the contribution budgeted standard? Because we need 832 plus 640, but it is the total contribution, right? We need per unit. So standard contribution per unit will be, get the totals, 832 plus 640 plus 320 less 2600. So my contribution totally is 808,000. Okay, this divided by number of units, which is 40,000. So contribution per unit will be 20.2. Okay, this is my contribution per unit. Okay, let's do further. Now Marcus is angry about having to attend the meeting as he has no involvement in setting the original budget, and he believes that the adverse results are due to the following circumstances which are beyond his control. A decision by Grey Shot companies, if you look at this, the budget is more, actually less. You can see the actual profit is much less than the budgeted profit. Okay, so definitely it's an adverse variance. Now look here. A decision by Grey Shot Company's board to increase wages meant that the actual labor rate per hour was 25% higher than the budgeted. This decision was made in response to a request by the production department to enable to meet it to a large one-off customer order in the last quarter. So the wage rates were increased. Due to the closure of a key supplier, Grey Shot Company agreed to contract with an alternative supplier to pay 6% more per kg than the budgeted price for material. The actual cost per kg of material was 4.4. Then third one, difficult economic conditions meant that market demand for the entity was lower by 10%. At present, Greyshot Company does not operate system of planning and operational variances. That means this question is based on it. Let's see the first one. What was the market share variance for product MN for the last quarter? Now you already know the contribution per unit, so we will multiply the difference with 20.2 that we have calculated, correct? Now let's see the difference. It's a market share variance, not size. So it's an operational variance. We will take the difference between the actual is 38,000 and the revised budget is 10%. It's lower. Okay. The revised budget is to reduce it by 10%. So let's calculate the revised budget. So the revised budget would be original budget less 10%. Original budget had put the sales at 40,000. So 40,000 less 10% of 40,000. Right? So that will be 36,000. Now you will just use this difference. So the actual is 38,000. Okay. And you will reduce 36,000 the revised budget. So definitely actually we are doing much better. Hence it is going to be a favorable variance. So there will be a favorable variance of 38 minus 36 multiplied by 20.2. We get here 40.4. 40,400 favorable variance. Now let's see, we have this answer. Clear? Because actually we are doing better. I hope you guys are following. Let's do the next one. What was the adverse material price planning variance? Material price planning variance for product MN for the last quarter. Now there are price variations which are given here. That due to the closure of a key supplier, the alternative supplier is with an alternative supplier to pay 6% more per kg than the budgeted price. So what we have to just find the revised budgeted price, and then actuals is already given to you, get the difference. Okay, what is the revised budgeted price? Yeah, so revised budgeted price is 6% more per kg. Here the original budgeted said that the cost per kg is 4. Now you just have to add 6% to it. 4 plus 6% of 4. So that will be 4 plus 6%. It will be 4.24 per kg. Clear? 4.24 per kg. Now just get the difference. 4.24 less actual is 4. Actual is 4.4. Wait, what we are calculating is planning variance. So there is no actual that will come. Planning variance means difference between the budgeted price and the revised budgeted price, right? If your revised is more, then it's an adverse variance. So here your revised is more, your original is less. Original was I think 4. Yeah, original is 4. So definitely it's an adverse variance because revised is more. That means you have to cost more to the company. And this multiplied by number of kgs. Now, as per the question, we require 5.2 kg per unit. Okay, 5.2 kg per unit we need. So, how many kgs are there? How many kilograms will be needed? 40,000. No, wait, actual kilograms are given to you. Do we have actual kgs given? Just 1 minute, I'll just cross check. Actual cost of material is 4.4. So when you divide this by 4.4, you will get 836,000 divided by 4.4, you get 190,000 kgs, right? So if you want to get the kgs, how will you get? See, cost per kg is given to you 4.4. So the number of kgs will be actual number of kgs, because you know that in variances we always multiply the standard cost with actual kgs. So number of kgs actual will be 8,36,000, that is 836,000 divided by cost per kg is 4.4, so it is 190,000 kgs. Okay, now let's use it here. So here I'll do 4.24 less 4 multiplied by 190,000. So when you do it, you will get an adverse variance because revised is mode. 4.24 less 4 multiplied by 190,000, I get here 45,600 adverse variance, which is option number C. Done? Okay, let's go to the next one. What was the labor rate? Again, just like material price, labor rate, operational variance. So very simple. Just get the actual labor rate. So let's see the question. A decision by gray short companies board to increase wages meant that the actual labor rate per hour was 25% higher than the budgeted. What is the budgeted labor rate per hour? 8. So the actual labor rate is, so budgeted is 8 and actual is 20% higher than this. 808 into 120% less 8. That means it is an adverse variance, since it will cost more for the entity for the labor cost. Once you reduce it, now multiply it with the number of hours, actual number of hours. So again we can work out actual number of hours. So actual hours will be 798,000 divided by labor cost per hour. Labor cost per hour is 8 multiplied by 120%, which is 9.6. So you divide it by 9.6 and you will get your actual number of hours. 798,000 divided by 9.6, I get here 83,125. But why it is coming like this? Wait, have I done something wrong? The labor rate is 8 per hour. It should be in round figures because the overall answers are round. So let me just cross check again. The actual labor rate was 25% higher than the budgeted. I think I took the calculation wrong. Here I think I wrongly took 20%. So it's 125%. Okay, so 8 into 125% is 10. 10. So here I will divide it by 10, not 9.6. So that is 79,800 hours. Now you know, so you just have to multiply this with 79,800 hours. So that means you have to just multiply 2. 2 multiplied by 79,800 is 159,600 adverse. Why adverse? Because your revised budgeted rates are more than the actual budgeted rate. So it is adverse. Clear? 159,600. And it is an adverse variance. So my answer is B, 159,600 adverse. I hope you guys are able to follow. Let's do the fourth one. Which of the following would explain a labor efficiency planning variance? Which of the following would explain a labor efficiency planning variance? Labor efficiency and planning point of view, remember. Now, a change in employment legislation means law, will require staff to take longer rest period. This can be a reason, no, when there's an adverse variance, and this can be a reason that a change in employment is requiring, change in employment law only is requiring staff to take longer hours. So if there's a variance at why it is negative, this is the reason. And since it is a planning variance, you can even see it is beyond the control of managers as it is given in the law. So managers can also not change it. Correct? Okay, let's go to the next one. Customers demanding higher quality products leading to a change in product design. Again, a planning variance only, not within the control of the manager. The learning effect for labor being estimated incorrectly in the production budget. This would be a reason, because if learning curve is taken incorrectly, the efficiency level is affected. So definitely it's a reason. All three are correct. Okay, let's go to the next one. Got it, Revati? Are you able to now understand with these questions? Please tell me. Just tell me now. Now, when I'm doing these questions, are you having the clarity that when it's a planning variance, you compare between the two budgets? When it is an operational variance, then what do you do? Am I clear? Great, great. Okay. Which of the following statements regarding the problems of introducing a system of planning and operational variances are true? Okay, which of the following statements regarding the problems of introducing a system of planning and operational variances are true? Okay, so it's regarding the problems. What are the problems that we can face for introducing a system of planning and operational variances? Let's check that. Okay, now operational managers may argue that variances are due to the original budget and being unrealistic. Absolutely correct. They can always um, they can always argue that, look, we are not the ones who are to blame with, it's the planners who are always going to be blaming with. So yes, that is the major problem that will always be there. Operational managers may seek to blame uncontrollable external factors, again on the same lines. So there can be a lot of blame game under planning and operational variances. Yeah, so that's very, I mean, that's very logical here. So yes, both are correct. Yeah, so we have done 3 case studies now so far. One on life cycle costing, another on limiting factor, third one on variances. Okay, let's take one more case study. This case study 4, I will take on, this is basically on the target cost and learning curve, almost kind of questions that we have taken earlier. So this is a case study that I will take in the second part, not today. Okay, now I want to take up some other topics today. So let's take case study 5. Can we? Yeah, case study 5 I'll take up. It's on transfer pricing. Okay, very good case study. This is the 4th case study. Okay, let me take one more and then I'll come back to it. Okay, let's do this one. Case study 6 I'm taking first and then I'll take case study 5. It's a very good case study. I'm keeping it for the end, so don't go out anywhere. I mean, don't leave the session. We will have after this a case study on the transfer pricing. I mean, that is, I know with all of you, this is a topic that requires like 100% in-depth understanding, going into the detail that we will be doing. And guys, just as a reminder, if you're not subscribed to the channel, please do subscribe to it. Please like the video if you think it's useful, and do share your feedbacks in the comment section, as I'm sure it is going to be very encouraging for me to come up with more and more different videos for all of you. Okay, so now let's do case study 6. Is the Hair Events is a company which specializes in organizing. Okay, so it is specializing in organizing um, sports events in major cities across Thailand. It has approached the local council of Edglas, a large city in the north of Thailand, to request permission to host a running festival which will include both a full marathon race and a half marathon race. Let's continue with one more paragraph. based on the prices that it charges. Now, can you see I underline the parts? In exam, you may use a highlighter, and you don't want to use anything, don't use anything. Okay, you can just write some notes. When I gave my exam, and that was a center-based exam, I used to write for every question just 1 or 2 points that I want me to remember. So that I would write on a rough paper. So that you can also do. Okay, based on the prices, the charges for entry to similar events in other locations, Hair Events has decided to put an entry fees of 55 for the full marathon race and 30 for the half marathon race. It is expecting that the maximum entries will be 20,000 for the full marathon and 14,000 for the half marathon. Here Events has done a full assessment of the likely cost involved. Each runner will receive a race pack on completion of the race, which will include a medal, t-shirt, water and chocolate. Water stations will be needed to be available at every 5 kilometers point along with the race route, stocked with sufficient supplies of water, sports drinks and gels. These costs are considered to be variable as they depend on the number of race entries. So these will be variable. Okay, now Hair Events will also incur the fixed cost. Fixed cost, like it will need to pay a fixed fees to the Eggless Council for permits, road closures and support from the local police and medical services. A full risk assessment needs to be undertaken for insurance purposes. The marketing campaign is planned via advertising on running websites, in fitness magazines, and at the other events that the Hair Events is organizing in Thailand. And the company which Hair Events usually employ to do the race photography has also been approached. So these are all the fixed expenses. Now, the details of the cost of full marathon and the half marathon is given to you. This is the variable cost and this is the fixed cost. Give it to you. If Hair Events chooses to host only the full marathon race, what is the margin of safety? How would you calculate it? You have got the budgeted sales, the demand is given to you, that is, and you have got you just have to calculate the break-even sales. And the difference you will get the margin of safety. Okay, so this approach should be clear. Let's calculate it. First, my budgeted sales is given to me 20,000, the maximum demand. Okay, now let's calculate break even sales. So that is in units we are calculating, right? Numbers, not the value. So I will use the contribution per unit approach. What is the total fixed cost? Let's get the total of it. So 385,000. Okay, 385,000. Now, the break-even point will be 385,000 divided by contribution per unit. What is the contribution? The price has been fixed for full marathon, right? 55. And the cost is coming out to be, variable cost is for full marathon 15.8 and 2.4. Right? So, what is the contribution? We can calculate for both. So, for full marathon, contribution will be 55 minus 15.8 and minus 2.4. So I will get here. And for half marathon also I can calculate. Half marathon selling price is fixed at 30. 30 minus 10.8 minus 1.2. So what is the contribution here for the full marathon? 55 minus 15.8 minus 2.4. We get here 36.8. And for half marathon, 30 minus 10.8 minus 1.2. That is 18. Okay. So 18 and 36.8. So now here I just need for the full marathon, so I will divide it by the full marathon contribution per unit only, which is 36.8. So my break-even sales will be 385,000 divided by 36.8, which is 10462. Now we can calculate margin of safety. So that will be equal to 20,000 less 10462 divided by 20,000 multiplied by 100, and I get here 20,000 less 10462 divided by 20,000 multiplied by 100. I get here 47.69%. So as per this, my second answer is correct. I'm sure we are able to understand. Simple question. Okay, now the next one. Assuming that the race entries are sold in a constant sales mix based on the expected race entry members, what is the sales revenue here event needs to achieve in order to break even? So constant sales mix is there. We need weighted average break even, right? So my weighted average break even point, oh no, break even point here would be fixed cost by weighted average contribution per unit. Correct? Weighted average contribution per unit. Clear? Okay. Now, fixed cost is already given to us 385,000. We just need to calculate the weighted average contribution per unit. So, here I will calculate weighted average contribution per unit. So, that will be equal to, let's see, what is the data given to you. The question is asking you the break-even point in units. No, the answer is in dollars. So either we multiply with the selling price or we can get the weighted average CS ratio. Right? Then we can get the weighted average CS ratio. Get the total contribution by total sales. Okay, like this we can get. Okay, let's calculate it. But let's see the data what we have. So we have got the contribution 36.8 and we have got the contribution 18. And what is the sales mix? Sales mix is constant. That is 20,000 entries here and here 14,000. Right? In this ratio, we will be working it out. Clear? 20,000 and 14,000 is my ratio. Okay, so first let me calculate. I'm just thinking if I use the break-even point, then I just multiply with the weighted average sales. Then also I can get the answer. So we can do it that way also. Okay, let's try out that way. Let's have weighted average contribution divided here. Then we'll multiply it with weighted average selling price. Yeah, that can also be done. Right? Yeah, so my weighted average contribution will be 36.8 multiplied by 20. So instead of 20,000, I'm taking 20. Plus the other one was 18. 18 multiplied by 14. 14, no? 20,000 and 14,000. 14. Okay, get the weighted average contribution. You get here 36.8 multiplied by 20, which is 736, and 18 multiplied by 14, which is 252, plus 736 is 988. Let me just check here again. 736. So I will get here 988. Okay, this is my weighted average contribution. Now you divide it, and break even point in dollars then would be, you will multiply this with weighted average selling price. Weighted average selling price will be, what is the selling price here? 55 and 30. 55 into 20 plus 30 into 14. So you will get here 55 multiplied by 20 is 1100. 30 into 14 is 420 plus 1100. 1520. So Revati and others, just understand that. See, sometimes when I'm not able to, I've done the calculation like this. Now, then I realize that I want the answer in revenue. No worries. You have the number of units multiplied with weighted average selling price. That's all. So here I get 1520. Okay. Now when you divide it, let's get the answer. 385,000 divided by 988. That is 389.67. 68 actually. 389.68 units. Now you multiply here 389.68 multiplied by the weighted average selling price, which is 1520. So there may be differences just in decimals, that's all. Otherwise it will give you correct answer. Okay, so 389.68 multiplied by 1520, 389.68 multiplied by 1520, I get here 592,313. 313.6. Okay, this I get my answer in dollars. Now, of course, there can be variation in the answer. Let's see the options, but I'm telling you both ways you can do. And if you want the dollar value, you can divide the fixed cost by CS ratio, weighted average CS ratio, or if you divide it by weighted average contribution, then multiply it with weighted average selling price. You will get the same answer. Just a bit of variation in decimals, and that's acceptable in the exam. So here 592,314 approximately, which number do you find it very near to it? 592,000. So this is my correct answer. Clear? Great. Okay, let's do the next one. Hair Events wishes to achieve a maximum total profits of 500,000 from the running festival. What are the number of entries that Hair Events will have to sell for each race in order to achieve this level of profit, assuming the constant sales mix is there? So we just need to get the break-even point in units then, right? Break-even point in units, and that I will bifurcate in the two categories. So here my break-even point in units, everything else remaining same. Just that we will have to add a target profit of 500,000. That's all. So with the fixed cost, I will add 500,000. I divide it by weighted average contribution per unit, which is 988. So I will get here 885,000 divided by 988. I get here 895.75 units overall. But now how much would be for full marathon and how much will be for half marathon? Okay, you need the units, right? So just multiply with them the weights. What is the weight that I've given? 20, right? So just multiply it with 20. 895.75 multiplied by 20, I get 17,915. Okay, easy. You've got the break-even point weighted. Now, when you want to know individual figures, just multiply the weights. That's all. Keep this step very easy because I've seen students being very confused with weighted average. So I hope this approach solves it. 895.75 multiplied by 20. So that will give me 17915 entries. Right, and for half marathon 895.75 multiplied by 14. So that will give me 895.75 multiplied by 14, and that will give me 1254.05. Okay, 1254.05. So now let's see which is the correct. No, I think it's 12540. Now let's see which is the correct answer. Full marathon 17,915 and 12540, the first option. Clear? Easy? Yeah. Now let's go to the next one. Hair Event is also considering including a 10-kilometer race during its the running festival. It is expecting the race will have an entry fees of 20 per competitor and the variable cost is 8 per competitor. The fixed cost associated with this race will be 48,000. The selling price per competitor, variable cost per competitor, and the fixed cost for this 10-kilometer race all increase by 10%. Which of the following statements will be true? So what will be the revised selling price? What will be the revised variable cost, and what will be the fixed cost? The revised selling price will be 20 multiplied by 110%. that is 22. Revised variable cost will be 8 multiplied by 110%. 8.8, and fixed cost will be 48,000 multiplied by 110%. That is 52,800. Done. So we have got the revised figures. Now first get the existing break-even point and then you will take the revised break-even point, because every pointer is regarding the break-even point. So let's calculate it here. What is existing break-even point? Very simple. The fixed cost divided by 48,000 divided by contribution. Here the contribution was 12 and here your contribution will be 22 minus 8.8. That is 22 minus 8.8, 13.2. Right? Now let's just do the calculation. So existing break-even point is 48,000 divided by 12 and that is equal to 4,000. Okay, but the question is also discussing about break-even revenue. So what is the break-even revenue? Break-even revenue will be this multiplied by the selling price, which is 20. 4,000 multiplied by 20, which is 80,000. Okay, likewise, let's calculate it again for the revised portions also. Now, what is the revised break-even point? Revised break-even point will be 52,800 divided by 13.2 and break-even revenue will be this figure multiplied by 22. Okay, now 52,800 divided by 13.2, I get here 4,000 only and break-even revenue will be 88,000. Okay, so we have got the break-even point and break-even revenue. Now just see what is the increase in volume. So there is no increase in volume. And what is the increase in break-even revenue? Let's do 8,000 divided by 80,000 multiplied by 100. 10% increase in revenue. Now just see which option gives you this correct answer. So break-even revenue will increase, break-even volume will increase by 10%. Wrong. Break-even volume will remain unchanged, but break-even revenue will increase by 10%. Absolutely correct. No need to look other points also. Correct. Okay, let's go to the last one. Which of the following statements relating to the CVP analysis are true? Boss, what is the statements regarding the CVP analysis? They are true. Let's discuss here. Production levels and sales levels are assumed to be same, so there is no inventory. Absolutely, it's the basic assumption that is covered here. Number two, the CS ratio can be used to indicate the relative profitability of different products. Yes, the relative profitability, absolutely, because we're comparing contribution with sales. The CVP analysis assumes that fixed cost will change if output either falls or increases significantly. No, we assume the overall fixed cost will remain constant. Then sales prices are recognized to vary at different levels of activity, especially if higher volumes of sale is needed. Sales prices are recognized to vary at different levels of activity, especially if higher volumes as no, we consider sales prices to be constant. So this is also wrong. Your correct answer is 1 and 2 only. Okay, now let's take the last case study and then the other 5 case studies we will take tomorrow, but not on YouTube, at a regular class. Okay, this is a very interesting question on transfer pricing. Mob company manufactures electronic mobility scooters. The company split into 2 divisions, the scooter division, Division S, and the motor division, Division M. Division M supplies electronic motors to both Division S and to external customers. So it is supplying to both. The 2 divisions, they run as autonomous profit centers. Division M has the freedom to decide how many motors to sell to Division S and how many to sell to external customers. And Division S may buy motors externally or from Division M. Okay, so Division S may buy motors externally or from division M. Details of the two divisions are given below. Division S budget for the coming year shows 35,000 electronic motors will be needed, and external supplier could supply these two divisions at 800 each. Division M has a capacity to produce 60,000 electronic motors per year, and the details of M's budget is given to you. What is the M's budget? That budgeted sales volume is 60,000. Selling price when they're selling it externally to the external customers is 850. Okay, and variable cost per unit for external sales is 770. The variable cost per unit for motors sold to division S is 30 per unit lower due to cost savings in distribution and packaging. So that will be 770 less 30, which is 740. Maximum external demands for the motor is only 35,000. So there is a spare capacity of 60 minus 35, 25,000. Units. Okay, so there is a spare capacity of 25,000 units. The transfer price per motor is set at 760 per motor. If the transfer price is 760 per motor, then how many unit motors per year will division M be willing to sell? See, the transfer price that is 760 per motor. Okay, when they are selling it externally, then they are selling it at 850. Okay, now, what is the maximum that they would like to meet here? What is the maximum for 760? Let's do the calculations. So basically, I think it's simple. They would only like to use their spare capacity only, because otherwise 850 is the price that they're charging from external customers. They would prefer that. Why would they like to go low? And even variable cost per unit of external customer is 770, though internally it is 740 only, but they will be, the company is asking them to transfer at 760, right? So when they are looking into pricing, they would be looking at the minimum price. Minimum price to transfer will be the variable cost, which is 740 plus the contribution lost. What is the contribution lost in this case? Look here. Contribution lost will be 850 less 770, correct? 850 less 770, which is 80. So now by applying the opportunity cost principle, what is the minimum price that the division, the selling division, would be ready to sell at variable cost plus lost contribution? Variable cost here is 740 plus 80, that is 820. So they would not sell at minimum at below 820. That means this price is lower than this. So what they will do at best is just to use their spare capacity. So they would sell 25,000 units only at this price and not beyond it. Clear? Now let's go to the next one. Interesting question. Now let's go to the next one. How many motors should division M supply to division S in order to maximize the group profits? Again, same answer. Because even if they want to maximize the group profits, they cannot sell at a price lower than 820. So maximum they would like to sell internally is only 25,000 units, as the opportunity cost concept is not covered. Clear? The opportunity cost is not covered here. Okay. Now, question number 3, assume that now there is a change in circumstance. So it says that assume that the division M has a spare capacity to produce 28,000 motors. Head office has now introduced a new policy stating that division M must sell 35,000 units per year to division S. Okay, they have set this policy. So if it wants division M to set a total price for all 35,000 units. So now division M will sell a total price for 35,000 units. Now it has a spare capacity in this question for 28,000 units. I'm explaining this, that how would I be solving it. The remaining are 7,000 units. Okay, 7,000 units. Now here I would like, I mean, for 7,000 units, we know that they are already selling it to the external customer. So it is already the full capacity. Okay, now if they want to move this units to their regular, okay, sorry, to the internal, to meet the internal demand, they would not go for a price lower than 820, remember, because they want to cover the lost contribution also. For the spare capacity, yes, we can do it at uh, the asked price of 740, the variable cost, right? Because then the minimum transfer price becomes the variable cost. But for the 7,000 units, which is at full capacity, we will do it at 820, as we will take variable cost plus lost contribution. That is opportunity cost. Clear? So here the value will be 7,000 into 820, which is 57,574,0000. And here it would be 28,000 multiplied by 740. So it will be 20720000. Now we can add the two. When you add the two, the total figure that you will get would be this plus 55740000. No, too many double zeros are added. Yeah, so I get here 26460000. Okay, when you add these two, you will get 26460000. I'm sure now it is absolutely crystal clear to everybody how we are handling the transfer price cases. Now let's do question number 4. Which of the following three are the objectives of a good and ethical transfer pricing system? Very important question. Which of the following three are the objectives of a good and ethical transfer pricing system? To ensure that decisions taken by divisional managers are in the interest of an organization as a whole. Absolutely. To assist managers in budget preparation, no, they are not helping in budget preparation. To give divisional managers autonomy in making decisions, absolutely. To encourage divisions within an organization to trade with each other rather than buying or selling externally. No, no, no. Here it doesn't serve that you just have to serve internally. Do a mix so that overall profitability of the organization is maximized. Now, to allow fair measure of divisional performance, absolutely. To transfer profits into lower tax jurisdictions, no. So the correct answers are A, C, and E. Great. Let's go to the last part of your last case study. Which two of the following statements about the use of the full cost plus method of setting transfer prices are correct? So which two of the following statements would be correct? It always, full cost plus method means what? That you are using an approach of the selling division is setting a price at full cost plus margin. Full cost plus margin. So it always ensures that the supplying division is compensated for the opportunity cost. No, we're not taking here any opportunity cost. We're just taking full cost and the margin. That's all. It motivates a supplying division to keep costs under control. No, rather they would look into increasing the cost so that they get good price. So that's absolutely wrong. The transfer price covers the cost of production of supplying division if actual output exceeds budgeted output. Absolutely. Absolutely. It is, that is why we say it's a full cost. No, it is covering the cost of production. It may lead to dysfunctional decisions. Absolutely correct. If the supplying division has spare capacity, because why it would lead to dysfunctional decisions? Because it would then charge even for the spare capacity the full cost plus margin. So that is like unnecessary, increasing the price. And from the group perspective, it is going to be, it is going to be negative because the buying division will not be ready to buy at this price, and then the selling division will still have spare capacity and its capacity will get wasted. And buying division instead will buy at a price which is lower than the full cost plus margin but higher than variable cost. So overall the entity will have a loss, right? So therefore this is correct. I hope I have been able to make your concepts absolutely clear with these 5 different case studies that we covered. First, I covered from life cycle costing. Second, I covered from limiting factor constraints. Third, I covered from variances. Fourth, I covered from CVP analysis. Fifth, I covered from transfer pricing. Now, we will have more different 5 case studies that we'll cover tomorrow, but not on YouTube Live. We will cover it in the session. So see you guys, and I hope that these materials here, section B and section A, are serving as a good study point for all of you. If you want to know about the section A video links, it's already there in the description jar. And guys, I hope you're not forgetting to like the video, subscribe to the channel, because I am going to be having more and more videos for your study assistance. Also, for the PDF copy of this, please join the Telegram channel, which is there, the link of which is there in the description, and you will find the notes there in the channel absolutely free. Thank you for joining, guys. Bye bye. Take care.